Well, hello and welcome to another episode of MoreTalk. It's another consecutive Thursday for us where it's 2 p.m. Eastern.
And it is 11 a.m. in sunny San Diego.
Michael and I are excited. We are getting very close to wrapping up Season 2 and having Season 3 be much higher in production on the Spotify, Google Podcasts, YouTube Podcasts, and coming soon to Apple. So if you're listening to us, please give us a subscribe and a like. And as you know, you can use hashtag MoreTalk, MORETALK, to find us because we do run the longest running, besides Dave Licken, the legend, running show where you can actually come and, unlike his show, we're trying to promote people calling in and asking questions and seeing guests and saying, okay, this is the easiest access to some of the best leadership. And today we do have some of the best leadership in mortgage. We have Roy George, who is part of MOR Lending, and he is going to talk, or we're going to ask him questions because it's very fitting, where he has been on the fundraising side and has run compliance and ultimately decisions, because it was either him vouching for companies or just being in charge of making sure nothing was going off the rails at these really large, well-funded or big organizations. And now he has taken a opportunity over the last couple of years to get to where he is running his own faster moving. He's the visionary. He's the leader. He's able to decide where it's going to go. And he can talk about how he's used diversity of loan product too to get there. And then we will have Dan Snyder on, who is sort of the opposite, came as a broker and then as a IMB, one of those, as you've listened to on the past episodes, we have a lot of baby boomers, and then we have the gap, not enough Generation X leaders of the future, and then these next generation millennials and Gen Z. And Dan has a sort of one-up on those people coming to power because he's been able to get fast growth and then get some well-capitalized, actually the fifth largest VC in the world, and now a bank, which he'll tell the story behind him. So he's going the opposite direction that Roy went. And so I think this is like a really cool intersection show that only you and I might seem to pull off. And so I think, we'll start with Roy. How are you doing? We appreciate you coming on the show today.
Yeah, absolutely. I appreciate you guys having me on the show, and happy to have this discussion with everyone. And I'm always happy to share my journey and where we are now. And especially one of the things we talk about on the More Money podcast, which is something that my business partner and I put out on a regular basis. We're big on making sure that we don't keep our secrets to ourselves. We're big on the non-gatekeeping side of information.
When you look at where Dan is today, it kind of reminds me of early on after, like when Better first started, except the difference might be, obviously there's huge differences, right? Like in Dan's an existing IMB that's really going to get more tech side, and he'll talk about expansion. You are, or Better was at that time, somebody that almost had money, now go solve a problem, right? But how does the mindset change from, a small group going around to all of a sudden you're on the clock to ROI, what you told everybody you were going to do?
Wow. There's about 3 helicopters above me right now, so I'm kind of like looking out the window while I'm talking to you.
It's like Goodfellas. You got to go back and make the sauce, and then you got to go here.
Yeah. So to answer your question, coming over to Better back in 2014, 2013, 14, sometime around there, we were just getting ready for the initial Series A raise, and I was there to assist and build out the compliance piece. I was their chief compliance officer. Most of my duties were really around making sure that we were putting the guardrails in, we were creating the guardrails, we were getting all of that set up so that we could make the presentations and say, hey, this is where we are, this is where the deal.
So you have everything in all lined up, and then from the beginning you were going to have to go out and raise money, or did they actually hire you? Because don't you have a background like a New York background?
Yeah. So they hired me because they were looking to fill that component, right? The raise or getting ready for the raise was already there. The Angel Series or the initial Series raise was already done. That capital was already in place. We were there for Series A, me and a few other people who I think only maybe 1 or 2 are still there. But we were there for the Series A raise with Goldman, and we did that just at the beginning or right around first quarter 2014, if my memory serves right. And we did a phenomenal job with that. That raise was actually probably one of the easiest that I've been a part of as far as presentation and delivery of information was concerned. I think that's partially because they were already a functioning company. Proof of concept was already there. The dev teams were very strong at that time, and they may still be. I don't keep up with them at all, but that part of it was really the core, right? We were building something that was going to be better than what was out there, no pun intended. And we were able to achieve that, right? Our overall goal was to get from a mortgage application to a loan closing in 100% digital format. For the duration of time between the angel round and Series A, we were able to prove that concept.
So then after Series A, is that where the pivots started to happen? And I ask pivot because I do want to segue into asking Dan in this environment if you're almost forced to pivot with the way the rates have pivoted.
Yeah, I think right after Series A was acquired, there were a number of other investors that came into play, and leading all the way up to the SPAC that they accomplished a few years later, or a few years ago now. And the pivot really wasn't changing the direction. It was more of a spearheaded effort to garner more funds or to create or capture more capital.
Dan, you seem to be capturing more culture with your recent acquisitions. Actually, a lot of former Easy Mortgage app clients I see of the 6 that you've acquired. So always great people. If they believed in an app early on, it's kind of my litmus test. They pass my common sense of realizing, where the consumer is. And I think that's sort of how you must have went out there and raised money, is you kind of passed everybody on understanding this new consumer behavior, but there's still obviously some work to do on connecting those dots with how the traditional mortgage is manufactured. Do you want to get into maybe that a little bit, what it's like taking to where you were, and then what is this next journey like as a leader, because it's sort of like everything's changed. So I feel like we're making progress. Dan, you can chime in whenever you want on that question. And Mike, do you want to ask a follow-up for Roy while we wait?
Roy, I was looking at your background. It just seemed for me counterintuitive for someone who's basically been in compliance to all of a sudden go to capital raisings, Series A, from angels, and then all of a sudden into Wall Street. So tell me about your journey, about how you went from compliance into capital raise.
That's interesting. I didn't actually leave the compliance space when I joined that team to help with the capital raise. I actually came on as their chief compliance officer. So my primary goal was to make sure that anyone looking from an investment standpoint saw that the proper guardrails were in place, that we'd put everything into order, created all the policies, procedures, all the documentation that went with that, and then being able to execute that on an operational level for what we were originating at the time. My background over the last 15 years or so, maybe less than that, was in the compliance space. And that's where a lot of people know me from 2010 till about 2020. But I was on the operational side prior to that with Citi, and ran their wholesale mortgage operations for the U.S., all regions. And prior to that, on the servicing side. So in my time period with Citi, I was able to get my feet wet with dealing with Wall Street, dealing with secondary loan pool sales, starting to meet the people that I would eventually grow with. And as they became, individuals that moved on to different trading firms or went to companies like Goldman, I had a lot of connections at those types of places. Not to take anything away, I didn't have anything to do with who we chose to get capital raised from. That was 100% Vishal, who led that charge and had all those relationships in place. From that aspect, I thought he did a great job with that. And, my compliance journey came because in 2008, when everything fell apart, I had been called into a number of depositions through that next 2-year period. And it kind of got me to a space in my head where I thought maybe I was part of everything falling apart. I decided to change gears and go into the compliance space. But, with that operational knowledge, I was able to serve as a head of compliance for servicing platforms, origination platforms, both on the banking side and the IMB side. Coming over onto that raise with the IMB that is better, we were able to just focus on my compliance background and knowledge to help drive that. And so there was no real transition from compliance into dealing with the capital raise. I was just part of the puzzle to actually accomplish or check the boxes to get that raise.
Awesome. It just seems like that you fit the perfect mold for someone that's entering in the current environment. I think it potentially might have been a little bit different 10, 15 years ago. So in today's environment where, we have much stringent lending guidelines. I'm comparing, of course, to 15 years ago, and currently where strategically versus 2 years ago, you have better yield now. So it seems like that your business model seems to fit with the alignment of the current environment. What is it like right now for you to now? Are you leading the charge in sales as well?
So it's interesting. I came to MOR as a hired employee, as their president. They had some inner turmoil at the founder level. They decided not to stick around. I saw a great opportunity, and I ended up buying the company. And there was a very young salesperson here who I saw a lot of drive in, and I saw a lot of similar characteristics to when I was a 20-year-old person in this industry. And so upon the purchase, shortly thereafter, I said to him, I said, listen, I need somebody to run the sales, and while I am operating this business, I intend to grow it into a mini core, eventually into a correspondent, which is where we're transitioning to at this moment, and then take it to a direct lender. And so for him, it was, wow, you're going to give me an equity stake to do this. And, he handles the sales and marketing piece. All the origination and everything comes through his teams, our teams in South Carolina, in Georgia. That's where all of our loans are derived from. And we do business in California, Colorado, Texas, a few other, Tennessee, a few other places. But the majority of our volume comes out of those 3 states in the Southeast, and he handles most of that. I am doing what we intended to do, which is grow this business into a space where we can get into maybe 15 to 20 states. I don't know if I see more than that in the long run. I have 15 or 20 strategic states that I really want to be in over a period of time. But no, I handle everything else, and he handles the sales and marketing piece. So origination, loan origination, the sales side, all comes from him. And you might see him on, or you might, if you've watched our show, you've seen him. His name's Joel Gonzalez. And that gentleman there, and by the way, phenomenal gentleman. He's only 24 years old, and he's been with me now for 3 years. So he started out literally as a guy who helped us move into the office, and then asked us what we did. And he went out and got his license on his own accord and came back 30 days later and said, give me a job. That's the guy who's been driving the sales side of this endeavor. Naturally, my coaching is there for him to get to where he has gotten, but a majority of the sales and what he's been doing to train and build is all from his personal training. He goes out to a lot of different events, things like that. So for me, it's really about, the accounting side, the strategy side, all of the things that kind of make us move in the right direction. And for him, it's about building the volume and building the new team. We both recruit on a regular basis, but he recruits LOs and I recruit branches.
That's awesome. So that's great that you can have that type of leadership. What I have found in speaking to a lot of the IMB leaders in the last few podcasts is that great leadership also means that they have that willingness to learn, to read, and to also be led in some. Who are some of the colleagues that you think that you are currently either collaborating with or networking with right now that you look for leadership as you grow from correspondent to direct lender?
So, I don't really reach out to a lot of people for that. And the reason for that is because in my last role before exiting that corporate space and trying to build my own corporate space, anti-corporate space, whatever you want to call this, I was part of an organization that was built very similarly to the way I'm building this. It was a sole proprietor who came on and started a small brokerage, mainly focused on builder business. And then about 6.5, 7 years later, she was able to sell her company to a large home builder and become the captive mortgage arm. From there, about 8 years later, so when she sold it, she became mini correspondent using Flagstar as her mini correspondent partner, then eventually turning correspondent. 2015, myself and one other gentleman who is currently their chief revenue officer, we came on board, and it was right after I left from Better, and they recruited me down here to Florida. This was Taylor Morrison Home Funding, and we took them from correspondent into the direct sales avenue, dealt with all the MOR audits and the preparation for that transition. And so I took a lot of my cues on how I'm building this based off of what I learned from her, as well as, making some adjustments for the things that I think could be done differently.
I'll ask, when I heard a motivational speaker talk about how there's 3 lenses. So there's your past lenses, which is very relevant for this industry. And he says if you're using these lenses, 2 of them not good. So comparing yourself to the past. And then there's the pleasing lenses, which is you look at the eyes of your competitors, you try to keep up with your competitors, you look at the market of your competitors, and then there's the power lenses, which is you kind of understand where you're going. That to me, Roy, seems like you're really at peace and in your power lens of where you want to go. You didn't stay where you were. You're on this new journey. Can you talk about the freedom of kind of working for yourself, having your own vision, and using your power lens?
Yeah, absolutely. So I agree with you. The motivational speaker speaking about those 3 lenses, it's great. Your past lens, it has to be there, right? Because you need something to say, hey, I've seen this happen. This is what I don't want to happen. These are the other things that I've seen happen that I think are phenomenal, and I'll keep in line with those. But at some point, I wanted to say, there are things that I think would work better that I cannot just implement at a large company without going through all the red tape of a large company. And so I came out on my own, not only for the freedom to say, I want to add different technology, I want to do this a little differently. I want to capture, business that may not be in the wheelhouse of any of the companies that I worked for before. And so I was able to build out something here that has a large product array. And I honestly, when we first started out in 2020, and, we were just a broker, and it took us about 6 months before we became that mini correspondent. And then here we are 2 years later going full correspondent. It was really being able to look at that path forward and saying to myself, I know how to do all of this. I've seen it done. I've participated in doing it. And the freedom of looking at my path forward and saying all the bells and whistles that were in place because I thought they would do the best, it is the reward for myself. From a mental perspective, I'm able to utilize tools that in other places I had to worry about vendor management, and I had to worry about executive board approval and all the other things that slow it all down, right? And that's our industry in general. Our industry is, hey, how many risks are there? How many things are going to be adverse to the organization if we decide to try something new? I really wanted to get away from that part of the world. Now, my compliance mind allows me to, analyze those risks and understand what I can and cannot do, even though I'm pushing forward with a lot of things that, maybe other people just don't want to try yet. And a good example is we've moved over to a completely AI-driven CRM that we build ourselves, right? So it wasn't, hey, let's go out and get this from somebody else and then have them build out the AI for us. But we went ahead and did it ourselves. And that's some of the beauty and the freedom that you get from moving away from that space and going this route.
Dan, it sounds like you might be on.
I've been listening. I've been listening along, so it's been great so far. But now I can.
All right, awesome. What would you like to contribute then? Say this is a whole dartboard now. You can throw it any number based on what you just heard. Again, you guys are almost like at inverted slopes as far as kind of the size, right, of or the scalability. But at the same time, I think you guys are both at the same pace of completing your vision, or as I said, the power lens versus, the pleasing lens really stood out to me. Like, careful of your competition. When I was at Easy Mortgage Apps, once that one competitor kind of finally caught up and we were going head to head, I proudly said that drove me. But when I'm looking at the pleasing lens, like, that's not a good thing. Like, you can't base yourself on your competition. And as you strive to get into that top 10 IMB, I guess you got to be careful of doing it your way and not just trying to catch up their way, right?
Yeah, I think so. I think that the past, the competitors, and then like the future, however you frame those lenses, is probably a pretty good jumping off point. I mean, I think that, like, if you've been in this industry for like during let's say the most recent cycle, where we went from like you can't lose to then everyone's losing, more than likely whether you're a team member or a manager or an owner, your world has completely been changed. And so if you linger into like the past, I'm like, oh my gosh, when I was making so much money, or I was promoted, or I was in whatever the role is, and now your life has changed, that can do very much good to like linger on the past. Like what I wish I could go back. Now it's like, okay, you got to move forward and you got to keep growing and do it smart. And you can maybe, implement some lessons learned. Clearly, like we've all learned a lot of maybe lessons. But at the same time, it's not like even historically we've ever seen where you go from a normal rate environment to a low rate environment, and then within 7 months you're in the highest rate environment in 40 years. I mean, it's just like no one's prepared for that. So you have to just kind of battle through and worry more on the future and what you're going to do about it going forward, and less on what's the competition doing and over indexing on that, or what are your peers doing, or what do you wish you would have, I wish I could turn the clock back. I mean, so like we spent a lot of time in the future, and that's what's led us into both leaning into a multi-channel approach. So we have online through lower.com. We have offline through our lower local retail branch network, plus a private label, like partnerships with, where we will do private labels for big groups. And then we have our wholesale business, but they all are contributing to the, lower as a company in a meaningful way. And we're embracing all those channels as we kind of make our run to top 10 or 5.
Yeah, that's why you were fascinating to me. And I think what you're pointing at in a great analogy, people know me as the analogy person, but I think the Kentucky Derby is a perfect example of what this industry is now. Like, everybody posts a gate, if I said that correctly, and because it's happened so long, everything you knew before might not apply now, because the tech is 2 years ahead of where it's actually been like race on. And I'll also add, Sierra Leone was a horse somebody paid $2.5 million for that was supposed to win, right? And this other horse bought for $10,000 and trained their way and did everything, grunt, hard work, probably got up at 6 a.m., the trainer, and not just the horse, but everybody involved. And that 40-1 horse won, but everybody's at the starting line. And I see that right now in the industry. And you said it on another podcast too. The reason it's now, Dan, I think all those houses that people thought they could have had at a payment at 5% or 4% are finally off the market now. So all the new houses they're looking at the normal rate of 7%, let's say, whatever it is today, but plus or minus that higher rate, as you know. So I think it really is game on now. Who can run the horses? And both of you, but what you just described is you have a really cool horse that is new here. And I think one that has all these bells and whistles, but you're recruiting IMBs, I think it's going to be a great opportunity for loan officers to ride the fintech wave, ride the prop tech wave, ride the financial advisor wave, but still be a loan officer at the end of the day. I'm excited to watch it. Do you kind of see that same starting gate mentality for everybody?
Well, I think certainly with if you took the top 50 lenders or what have you, it's not like 5 struggled and 45 are winning. Like everyone just got beaten down. It doesn't matter if you're Rocket or Loan Depot or Better or Lower, you name it, right? I mean, like arguably the bigger you were at the time, the more you took the fall. And so we were probably in a sweet spot where we were growing, diversified. We had team and founder led, and yet though we had some institutional backing. It was like we were in a good position to both weather the storm and then, think ahead about growth after the storm. And I mean, so that's everyone is now kind of like, I guess your analogy is starting over again. And so you have that. And then the other side of things, now you have technology improving so much. What used to take 150 engineers, maybe you can do with 8 to 10. I mean, it's nuts. So building AI CRM, right? That's something that when we were starting out 10 years ago, we're not doing, obviously. So I think that the rate of change with technology will help. And then just settling into at least a more normal environment, even if we don't love that rates are high and inventory is still relatively low, at least customer sentiment, employee sentiment is a bit more balanced than the, last 24 to 30 months that we've experienced.
It's counterintuitive to go out and start buying mortgage companies in a rising interest rate environment. The Federal Reserve now has telegraphed that there may not be any drop, but it's looking like maybe they don't lower rates, but maybe they instead make some capital markets purchases in MBS. I'm not sure, but to me it seems like it's something that would be there. And then it just seems to me that what you're doing for the originators also in analyzing their tech stack, figuring out what they can do to be better originators at the retail level. And I'm referencing your most recent interview with Housing Wire. It seems like there's a lot of positive things that's going on. Can you help me understand when it comes to putting together more capital, either for acquisitions or raising more capital so you can have a larger funding lines? What is it like going out into the marketplace and asking for more money? I mean, this is not only for our audience out there, but also for originators, salespeople, whoever, because it just seems like in an environment where it seems like getting more capital would seemingly be hard. It seems you haven't made it. You've made it. I'm not going to say it was easy, but I will say it was a little bit less seems.
Well, I think if we take a step back and look at, use the IMB acquisition strategy. We really have a unique opportunity to bring in a lot of talent and really create a win-win for maybe the exiting seller. And here's why. If you've ran an IMB for a decade or two, like some of our acquisitions, you have built up a great company. You're performing well. Those are kind of the 3 things we look for. We don't want necessarily to catch a falling knife. You've got good structure, alignment of culture, etc. Okay, so check the box. The difference is that if you're closely held, you're a family business, so to speak, you're an owner, a single owner, you've made a lot of money, and now you're just like capital preservation. Do you want to really grind it out over the next 10 to 15 years as an owner? Or would you rather sell your legacy into maybe a bigger dream? I think that's our approach. I mean, we're probably the number 1 outlet that's not a publicly traded company. So maybe we are the number 1 outlet for a exiting seller to really have their team and their legacy continue with us. For me personally, as an owner, when we went and raised our Series A, my co-founders and I, we remained in operating control, super majority of our equity in the company. And yet though, at the same time, we committed to a long journey. We committed to excel, that we're not selling the company in a couple of years. We're going to go build a really important company and make an impact in housing and real estate. And that's what we're doing. So when that if the sale is off the table for us, I mean, we're now long-term view. We want to build a really important company, and it makes it, I think, a win-win for the IMBs and the owners out there who I've talked to several, and we've done deals with several where I'm speaking their same language. I know exactly how they feel, and we've been able to structure some really favorable deals. I mean, with Universal Home Lending, with Thrive, I think a few others we've done over time, but it's been a good, important strategy for us. And then, so how do you find money for that? I mean, it's no different than if you're a loan officer talking to a realtor. It's just talking about what's the mutual vision. What's the, what type of, like for us, we want to build an important company. Investors want to invest in, put their capital to work where they know they're going to get a really good return. And so there's an alignment. If you've got a really great, powerhouse realtor, they want to work with a really great powerhouse loan officer. They don't want to work with an average. And so I think just an alignment, discovery, and so far we've had a lot of success. I will say, you can give a lot of credit to Excel. I mean, they've been phenomenal to us. Long-term vision. I think they're getting used to the mortgage industry. Yeah, I don't think they kind of knew what they were getting into, maybe, but not many did in 2022. We went through some unprecedented times, but
I think few understand like the power that loan officers have, right? I mean, you can see it in LO Comp. Like you end up competing against others, and so that you never really get to. It would almost be like if franchises like McDonald's and Starbucks, the people behind the counter, right, could leave and go, and then you're catering to, are you paying them, what we're giving them the benefits they need. The outsiders don't seem to understand that's a big dynamic, and once you get that, you do a lot better than others. Can you talk about, this question would be for both of you. Is there a value, Dan, on like data is king, data is part of valuation, not necessarily for your raise, but, when tech companies are out there, all these mortgage companies have an insane amount of data. They have data that I think some articles have said the home buyer data itself is worth about $10 trillion as a market. After close, etc. But when these companies go out, like in their Encompass licenses go out, are they able to sell that data like to a new mortgage company not on the market? When you acquire them, are you able to acquire the mortgage companies? Because I know like if a loan officer leaves, you don't delete that out of your Encompass. And that question would be the same thing for you, Roy, with the, playing the game, obviously at the big builder, but now that you're a broker, are you building your database like with anything in mind that there might be value in that, or is it considered such old data that it's not worth anything?
So I'll jump in here. I'll tell you that the data is really important for us. In my past lives, I don't believe the data was as important, but at my size and with our trajectory, the data and the consumer data that we have in file or in our databases are really important and actually are part of, valuations when it comes to, is there an opportunity to sell or exit some years down the line, or even if it's tomorrow for somebody that wants to, maybe take Dan on as their new boss and bring their branch into his world, right? So that data, there is some importance to that data. Like for instance, we have probably just over 2,700 different customers in our loan operating system. And that was actually something that we viewed with a recent inquiry into whether we would sell or not. That was a question that we were asked. And, we had no intention of selling at that moment in time, but surprising that anybody even wanted to this early in the game. We're not a direct lender yet. We're just transitioning to correspondent. And, for someone to say, hey, we want to make an offer, I was like, for what? And I said, I'm not coming with you. This offer doesn't include me. So for what? And that data was actually what they were after. How many people are viable leads, prospects, customers, consumers that have already done business, are potentially waiting to do business? I do think that data plays a big role in what the valuation of an organization could be and how much more your organization could be worth as you continue to accumulate it.
I mean, I'm not saying that data is not valuable. I think it's just I've seen no real value actually put onto it. It's not valuable for at least like I've seen in terms of like fundraising at all. It's not. I think that everyone just assumes we've got valuable data, rich data in our industry, and yet though, what are you doing with it? What are you allowed to do with it? There's a lot of regulatory and protections, and obviously in our space, and you can't just you can't just pick up a big database and then just start blasting them with marketing material. So
I guess that was my question, because like to me, I would be more interested in the company I'm acquiring, of the amount of people they have that were with a loan officer that does not exist at that company anymore, so that I don't have to deal with the one-offs. Like, oh, that's my doctor. You can't call him hey on your email, right? It's just like, we're going to start using today's technology to re-engage this platform and look at all this opportunity. We at least know their cell phone, their email. They know the brand that we're acquiring. There's some value there. We probably could figure out who's sub-servicing it or servicing. Yeah, like, is anyone asking that? Like, to me, that would be what I was interested in. Like, how many in this, if you're a 15-year-old company, how much do you have in your encompass of closed loans of loan officers that aren't here anymore, unless you gave them the blood oath that you wouldn't solicit them? And that would be another question. But does that get asked at all, or do you think that will be asked? Because otherwise the data is essentially stale, right?
So I can answer that last piece there. We did get asked that question. Did we have any non-competes in our compensation agreements and employment agreements? Did we have any clauses that specifically stated we would not go after clients? When we first built the company, one of the biggest draws were that we were open to, hey, these customers are your customers. If you decide to leave us, you can go ahead and take them with you, and we won't call out on them. And actually, what's happened to us in the last 2 years is the people who have brought in business and have left us have left the business. And so from that vantage point, being able to reach back out to those customers, because those LOs are no longer in the business, has actually brought new loans to us, new customers to us, and new people to our database who are going to be, long-term customers, consumers for us.
Or with the average age of loan officers, you maybe just wait 6 more years, right? Like, but it's still the same answer. So thank you.
Financial advisors often will say the saying, past performance doesn't dictate future results. What I'm noticing by both of you leaders is that you're not looking at the past to dictate what you should be doing. You're looking at the future to dictate what you can be doing today. And I've noticed that in your actions, and I've noticed that in what you're doing for technology, and for Dan, this is in acquisition mode, not necessarily for the money piece, but you're looking at what is the quality of the company that you're looking at. What is the tech stack they may or may not be doing? What can you do to improve it? And what is it that you can do? What are some of the features? I mean, you've said that you have common values. Can I ask for, what are your common core values that you look at right now? Because I'm sure that as you look at making acquisitions, the people who are providing the capital to you also have a similar value system as well. What are some of those traits, if I can ask?
You're saying specifically into like how to target an acquisition?
Yeah. When you're making that when you're targeting an acquisition, what are some of the value systems that you're looking for? Yeah, because I'm making the assumption that the value systems you're looking for are also your value systems.
Let's call it 3 things. Number 1, I look at time on job for the branches. Like, how long have they been a part of the company? Are they just part of the company because they took a frivolous signing bonus and now the signing bonus is up, they burn off? So it's like a 12-month or 24-month. Do you see some of that? We would avoid that. So, with Thrive as an example, and this is pretty consistent with all the rest, but the average tenure of their core team, their producers, their core producing team, 8 years on average. So you're like, okay, they've seen the good, they've seen some bad, they've seen some, they're kind of sticking together. So that's one, time on job, so to speak. The second is just the economics. Is the economics going to work within our model? I mean, so that there's enough to, we believe in the owner needs to be taken care of, and yet that we need to get enough to bring on the production and, for our company to get a good return. So that's the economic equation. It's pretty self-explanatory. And then the third is it are they normal people? So in other words, like I use the word normal because it's pretty basic. You don't have to be like, just like, are you really normal, good people? And then those are the three things. So it's harder than it looks not to actually, we've gotten a few reps now, so we're actually excellent at it. In fact, we had, one of my, our like top lieutenants is now taking on the head of M&A integration because we want to continue and do it with a level of excellence. But at the same time, I wish I could get more looks. I don't know. Like I read in the paper or like people text me after like, oh, did you hear this company's, didn't make payroll and is exiting. And I wish we would have had a look 6 months ago or 12 months ago prior to that happening, because maybe we could have prevented that from happening, if that makes sense. So yeah, that's on the M&A front.
Again, going back to the past performance doesn't dictate future results, but do you ever look at who have been some of the top producers, maybe not the top 50, but maybe the second 50, because maybe the top 50, they may be too entrepreneurial for acquisition, but maybe the second 50 as far as originators, or the third, like numbers 50 to 150. Do you look at them and say, okay, out of these people, they're with this company, what can we do to entice them? Instead of looking at, oh, we could have bought this company or that company. Are you looking at originators as well? Do your people look at that? If you're not looking at signing bonuses and whatever, because you want good quality people, I'm assuming your recruiters you're working with your recruiters to do that.
Yeah, I think that's on the acquisition side in terms of if you have on the acquisition side, you're trying to figure out, is this a really well-run company that's going to hold together? Or is it a sinking ship because it wasn't built with the right foundational elements, so to speak? And this is the reason why it's failing, is because everyone's leaving for greener pastures. You know what I'm saying? So that's on the recruiting of LO's side. Gosh, that's a whole nother topic, I feel like. We have, a company like us, so we have, while we're doing the acquisition on or building out our retail footprint, we're also doing some pretty incredible things on our online and digital side. So the customers that are coming in online have an incredible experience, and our productivity per loan officer on the inside team is like increasing 20% each quarter. And so that's really gaining steam. And then ultimately from a tech stack, what we end up inheriting through the acquisitions is like every vendor under the sun. It's like we have so many, it's like pick your roadmap of CRMs. And so we've seen a lot. Now we're just trying to, okay, what's the best, maybe there's a retail tech stack, which we recommend LOs, give them some flexibility. But at the same time, we're laser focused on, controlling the customer experience, driving down manufacturing cost. And for that, we're building a lot of it ourselves. We're using AI throughout some of the steps in the process to clean up the document processing in a little bit more efficient manner. I think ultimately the improvements in technology and the improvements in flow only benefit the customer and ultimately the folks on the file, like the loan officer. So independent of anything, we're trying to drive productivity of our LOs. Can you do more business? It doesn't matter where you're getting the business. And you can drive more business if you're not spending 85% of the time or over half, working with your processing staff or talking to the customer and trying to clean up a loan file. So that's, I think, the challenge that everyone's after is, how do you make that efficient as possible so you can focus more on delightful customer experience and acquiring more business?
Tech-wise, you're going to see a big shift in tech driven by per seat model and new tech coming in per customer close, per customer. I think there's not enough per customer engagement tech. Like if the customer's engaging in it, the lender shouldn't mind paying for it, whether that's pennies, 10 cents, or $1. But I see that shift, and if that's not going to come, you're going to have to build it in-house. Can you talk about what you're looking for in new tech and how hard it is to stay out of the manufacturing and try and get to the top of the funnel when you're building?
What do you mean on the top of the funnel?
I think your website is an elite website, right? I think that there are softwares out there to try and get consumers to engage earlier or even after the close. I just think attracting the eyeballs is important, but I see most leaders in technology trying to knock another operational task off, which maybe makes their workers' day easier, but I don't really notice the customer feeling it. Maybe they will in 2028, 2029, but I just think there's such a gap for kind of what you're doing. And it's like, how do you get customers to, when they're on Google, end up with you?
Like, we internally call it light speed. It's our point of sale. There's a number of point of sales out there that are really good, and you can use them as third party. So why do you have to build your own? I think you really have to build your own if you want to truly understand the customer buying behavior. And so that's what we did. And so behind the scenes, we can see all the raw data and every step of the process, and then change up the flows in order to do what? Convert. So if we, whether it's spend or have the opportunity to have, let's just use round numbers, 1,000 customers hit our site and start a flow. If your conversion's at, like our conversion, through the flow is north of 58% now. And, so it's 580 full customers that are committed through. That's up dramatically to when we first started this. When we first started, it was maybe 10%. And so that's a big difference in terms of your ultimate CAC and ROI that you're going to end up getting. So that's why we do it. I mean, we have that. And where in the process can you build your own tech so that not only because you still do spend money, whether it's on engineering or on all of the behind the scenes cost of the technology you build, but the tweaks you make, the changes you make, is it going to impact your business and your pull through? Are you going to get 580 swings versus 100? That's a big difference for the same amount of money to get them into the site. So that's where we focus a lot on that actual experience, and then flowing through into a portal, into a connected system to get the borrower to do less and get our pull through higher and higher and higher, and then, getting our talented, loan officer team, like highly qualified, ready to go customers, where they're educating them more on the payment, the locking the rate, making sure that they understand what's happening, navigating the home buying, all that stuff, versus, trying to make sense of a partial application and following up with the customer.
Yeah, that makes total sense. I'll give a real life example. I was working with a group, and we were analyzing a top 10 lenders' point of sale, and thousands of people applied. And everybody from the outside thinks that the reason people would fall off is their social security. They've been thinking it since I was a loan officer, and I do it verbally. Like, can I get everything without, and I'll ask the social later. But the number one fall off nowadays in this trustworthy environment where people were putting in socials was actually employer address, because people didn't know their own employer address. And that's where the largest fall off would be. If you didn't have your own point of sale, you would just always assume it's whatever you assumed coming in. And if that pull through is 580, versus 400 out of 1,000, that's a huge percentage difference. And so as you're looking for a place for your next home, and Dan is actively out there saying that he's looking for M&A, that is a metric. If you're bringing in 1,000 people, and right now your system's only closing 300, and he can get you up to 580, that delta right there might be worth it rather than some of the numbers you're looking at. So I'm going to leave you guys both with one final question for me, and if Mike wants to ask a final, we'll go over a minute or two here. My final question is for each of you, just as leaders who have been on the ground floor and now, been close to the ground floor, and now you're up there leading, running companies. What would you say to loan officers that would have a chance to work with you? What do you try to offer for advice, and how do you still communicate with the people out there originating every day with your companies?
I appreciate you having me on, and my advice, or whatever how you frame it, would be, I'm just grinding away alongside everybody. So, I mean, I'm literally jumping off here to go try to land a big recruit for one of our branches. So you just got to love the work if you're going to be in our industry. And so,
yeah, I can see why you look for normal, because you always sound so normal every time I talk to you.
Do my best. Someone would probably disagree, but do my best. Hey, good to meet everybody. Thank you again.
Thank you, Dan. And if you liked what he said and you're listening on Spotify, Google Podcast, or on our new Apple Podcast, please give us a subscribe and a like so you can get more of these great leaders within the industry. And if you ever want to join us live to come up and ask questions, we are getting some of the best leaders in the world, and we're giving you guys direct access to ask questions. Don't be shy. Hashtag MoreTalk, MORETALK. You'll find it on LinkedIn. It's Thursdays at 2 Eastern, 11 a.m. Pacific. And you can literally ask. That's why we do it live. It's not for the audience there. We get plenty of views thanks to where you're listening today. Again, on Spotify, Google Podcast, Apple. Roy, give you a chance to answer that question as well here.
So my answer is very much aligned with what Dan said. You know, when I am here in the office, the headquarter office in Miami, I am sitting right next to everyone. I am involved in what they're doing if they have questions. So I'm still on the ground, even though I'm not on the ground on a daily basis. And so my advice to loan originators is right now in this market, keep going. There is a turn coming. It is hard to see the end of the tunnel or the light at the end of the tunnel, but keep going. And, you know, maybe get to the right team or find the right company, or, you know, make some transitions that are going to help you get to the next space. If you are a solo shop somewhere and, you know, a company like Dan's is something that's going to help you get to your next level, then definitely, you know, get in touch with them. If you're if you're a small branch operation somewhere and you want to get into a powered by model, which is what we do, you know, get in touch with us, and we're happy to have the discussion with you to see if we can help you get to that next level, especially in this tumultuous market. So my advice to every loan originator out there that can do it is to keep going.
Awesome. Thanks so much, Roy.
Yeah, that's a beautiful thing. Thank you to one of our listeners, Jim Bopp. I will see you out there at the New York Secondary in a week or two. Thank you, everybody, for listening. We appreciate it. Julia Brown, great shout out from Dan today. And you are doing wonderful things in the industry. We saw there at the gathering. I think that's my only regret, Mike. I didn't ask enough questions about how the gathering was, but we got real serious and real awesome real quick.
I think if there was only one last thing I would really wanted to ask is to talk about servicing, but we're going to have to do that in the mic drop later, just you and I, Mike.
That's absolutely correct.